Have you ever wondered how banks make so much money? They're not just holding on to your cash, they're using proven financial strategies to grow their wealth. The good news is, you can use these same strategies to build your own financial future. It's time to stop thinking like a customer and start thinking like a banker. You work hard for your money. It's time to put it to work for you. In this essay, we'll explore 3 key banking principles: interest rate arbitrage, leverage, and compounding. We'll learn how to use them to potentially grow your wealth. Remember, this is not a get-rich-quick scheme. It requires careful planning, discipline, and a long-term perspective, but the rewards can be significant. By taking control of your finances and applying these strategies, you can create a brighter financial future for yourself and your family. So, let's get started on your journey to becoming your own banker. Interest rate arbitrage might sound complicated, but it's a simple concept. Banks borrow money at low interest rates and lend it out at higher rates. The difference between the two rates is their profit. You can do the same thing. For example, let's say you have a credit card with a 0% interest introductory offer for the first year. Transferring a high-interest debt onto this card is a form of interest rate arbitrage. You're essentially borrowing money at 0% and using it to pay off a debt that was costing you more. Another example is using a high-yield savings account to earn more interest on your money. You are essentially lending your money to the bank and earning a higher rate than you would with a traditional savings account. The key is to shop around for the best rates and minimize your costs. Leverage is about using borrowed money to potentially amplify your returns. Imagine you want to buy a house. You could save for years to pay cash, or you could get a mortgage. A mortgage is a form of leverage. You're using borrowed money to buy an asset that will hopefully appreciate in value. Investing in the stock market is another example. You can buy stocks with your own cash, or you can use margin. Margin is essentially a loan from your brokerage firm that lets you buy more stock than you could with cash alone. However, leverage is a double-edged sword. While it can amplify your gains, it can also magnify your losses. If the value of your asset goes down, you still owe the borrowed money. It's crucial to understand the risks before using leverage. Compounding is like a snowball rolling downhill. It starts small, but it grows exponentially over time. It's the principle of earning interest on your interest. The longer your money is invested, the more it compounds. Let's say you invest $1,000 in a retirement account that earns an average annual return of 7%. After the first year, you earn $70 in interest, but in the second year, you earn interest on $1,070, not just your original $1,000. This snowball effect continues year after year. The earlier you start investing and the more consistent you are, the more powerful the effects of compounding become. It's never too early to start investing and harnessing the power of compound growth. Section 5. A real-life example, putting it all together. Let's look at how these 3 principles can work together. Imagine you want to invest in real estate. You find a rental property for $100,000 that you believe will generate rental income and appreciate over time. You decide to use leverage and put a 20% down payment, meaning you need $20,000. You secure a mortgage for the remaining $80,000. This mortgage is a form of leverage. Now let's say you've been diligently saving and have $40,000 in a high-yield savings account. Instead of using all $40,000 for the down payment, you use $20,000 and keep the remaining $20,000 in your savings account. This is interest rate arbitrage. You're earning a higher interest rate on your savings than the interest you're paying on your mortgage. Over time, the rental income from the property pays down your mortgage, leverage working in your favor, and the value of the property appreciates. Meanwhile, your savings continue to grow with compound interest. By combining these 3 strategies, you've taken a significant step towards building long-term wealth. Section 6. Managing risk, protecting your hard-earned money. Before you dive headfirst into these strategies, it's crucial to understand the risks involved. Investing always involves some level of risk. There's no guarantee of returns, and you could even lose money. Interest rate arbitrage may seem relatively low risk, but remember that interest rates can fluctuate. If interest rates rise, you might end up paying more in interest than you're earning. Leverage, as we discussed, can amplify both gains and losses. If you're not careful, you could end up owing more money than you have. And even with compounding, there's no guarantee of consistent returns. Market downturns can impact your investments, especially in the short term. That's why it's crucial to diversify your investments, invest for the long term, and have a plan to manage risk. Section 7. Small steps, big rewards. Start building your wealth today. You don't need to be a Wall Street wizard to start building wealth. Start by implementing these strategies in small, manageable steps. Consider opening a high-yield savings account or exploring low-risk investment options like index funds. Look for opportunities to reduce debt and lower interest payments. These small steps can make a big difference over time, putting you on the path to financial security. Remember, building wealth is a marathon, not a sprint. It takes time, patience, and discipline. But by taking control of your finances and making smart decisions today, you can create a brighter future for yourself and your loved ones. So start small, stay consistent, and watch your wealth grow over time. You've got this! Section 8. The power of patience. Building wealth takes time. There's no magic formula or overnight solution. It requires patience and a long-term perspective. Think of it like planting a tree. You wouldn't expect to see fruit immediately. It takes time for the tree to grow strong roots, weather storms, and eventually bear fruit. The same principle applies to your finances. It takes time for your investments to grow, for compound interest to work its magic, and for your financial decisions to pay off. Don't get discouraged if you don't see immediate results. Stay focused on your goals, be patient, and trust the process. Remember, the most successful investors are those who stay disciplined and committed to their financial plans over the long haul. So buckle up, enjoy the journey, and watch your wealth grow steadily over time. Section 9. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old wisdom is especially true when it comes to investing. Diversification is about spreading your investments across different asset classes, industries, and geographical regions. Instead of putting all your money into one stock or one type of investment, diversify your portfolio to reduce risk. This way, if one investment performs poorly, the others can help cushion the blow. Think of it like this. You wouldn't want all your money invested in a single company because if that company were to go bankrupt, you could lose everything. By diversifying, you're creating a safety net for your investments and reducing the impact of any single investment's performance on your overall portfolio. Section 10. Staying informed. The world of finance is constantly evolving. New investment opportunities arise, market conditions change, and economic landscapes shift. Staying informed about these changes can help you make more informed financial decisions. Read books, financial websites, and reputable financial publications. Attend seminars, listen to podcasts, and follow financial experts you trust. Knowledge is power, especially when it comes to managing your money. However, be wary of get-rich-quick schemes or investment advice that sounds too good to be true. Remember, if it sounds too good to be true, it probably is. Always do your research, consult with a financial advisor if needed, and make informed decisions that align with your financial goals and risk tolerance. Section 11. Conclusion: your journey to financial freedom. Taking control of your finances and building wealth doesn't require a finance degree. By understanding and implementing the same strategies that banks use, interest rate arbitrage, leverage, and compounding, you can potentially grow your wealth over time. Remember to manage risk by diversifying your investments, staying informed about market trends, and seeking professional advice when needed. Building wealth is a journey, not a destination. It takes time, patience, and discipline. Start small, stay consistent, and never stop learning. You have the power to take control of your finances and create a more secure and abundant future for yourself and your loved ones. So take that first step today and begin your journey towards financial freedom.